Hello, ladies and gentlemen. Welcome once more to the Financial Times headquarters for the latest in our PWM expert series of videos made in conjunction with BNP Paribas. Our subject today is socially responsible and sustainable investing, and my special guest interviewee in the studio is Jacky Prudhomme, Head of ESG Integration and Social Business Investments at BNP Paribas Investment Partners. A very warm welcome to you, Jacky.
Thank you, Yuri.
Jacky, if a client comes to you and says, what is the difference between SRI, ESG and impact investing? What do you tell them?
Well, you're very right to ask this question because there is many confusion behind those acronym soup. So let's start with impact investing. It means that what you think when you invest into companies is first to get an impact, a positive impact, either in the social or environmental dimensions. You want to change things. You want to fight global warming, for example. You want to help people get access to education, to medicines, to food. So it's really first the impact. You want to get an impact, and then you want a financial return. ESG, on the opposite, is more how do you integrate the environmental, so E, S, the social, and G, the governance, risks of companies when you do invest in a company. It's more sort of extended way of assessing companies. And of course, to get rid of some serious controversies related to ESG, like infringement of human rights, social rights, etc. So it's more a risk approach. SRI is you seek for two things. First is, of course, an impact, but it's not the only, just say, objective. You seek also for a financial return of your investment. So it's something in between. You do some exclusions, where on the opposite for the ESG, you don't have those specific rules of investment.
I'm very interested in looking at some of the figures behind the trends. The latest statistics I've seen from the Novethic Research Centre show that I think there's 223 billion euros invested in socially responsible investments in France alone, with a 31% year-on-year rise, and the ESG figures are similarly impressive. What is accounting for this massive rise in investment in these spheres?
Two big reasons. The first one is the fiduciary duty now of asset owners. They are more and more encouraged, and sometimes they are also more and more pushed by the regulators to master the ESG risks of their investment. So they are pushing the market. They are asking asset managers now to integrate more and more ESG in the stock picking and the way they manage portfolios. But there is also a big trend now is traditionally the asset owners were more into the SRI funds. They came with their own values, with their own sets of criteria to exclude some sectors of industries, to exclude some companies. Now we have just a new kind of institutional investors. They are more just aligning with this big trend of ESG integration. It doesn't mean that they don't have any value, but for them, having ESG is more like sort of compliance. You want to make sure that you respect your fiduciary duty obligations or requirements, and you at least know exactly what you have in your portfolios, and you are able to prove, to give some proof of evidence that you have been investigating all the risks of your portfolio. And this is actually the big trend in the market. You have some traditional, just say, mainstream actors that are not known or labeled as SRI that are jumping on the ESG trend, especially because of this new context of promoting ESG in all the investments.
But as you say, there's people jumping on the trend, the money's coming in, but is there actually concrete evidence that including ESG factors actually improves investment performance?
This is very key. We have been doing it for more than a decade as an SRI investor. We can testify that first, it doesn't destroy value. It doesn't mean that because you exclude companies that you reduce your chances of having a financial return. On the opposite, I would say that the explanation is that you are just getting rid of the lagging companies, the ones that are just not strong enough to get a financial return. So it's very positive for the market to testify that doing SRI and if continue incorporating ESG can help just say at least safeguard your investment. And the next question is, does it create value? And it really depends on the way you manage your strategies. But what I can say at my company's level is that we have now sufficient track to testify that you can also overperform the traditional indices. It really depends on the portfolio managers. It's like in any company. You can have bad portfolio managers, you can have good portfolio managers, but if you have a good portfolio manager with the addition of this ESG toolbox, that is a great way to extend the way you understand the risks of the companies you invest in, but also a great way to identify new growth idea in some new promising activities like fighting climate change or addressing the demographic challenges of society. There you have an advantage and you can make money on this kind of investment.